Hey, what's up, everyone? Welcome to Technos Beginner Stock Talk. Tonight we're going to talk about Tesla stock and the overall stock market. Coming up, we got some important economic data coming out this week that could significantly affect the overall stock market, including Tesla stock. We also have Cathie. We're going to hear from Cathie Wood talk about her reasons why she thinks the federal government or the Fed, Chairman Powell, whoever, is making a bad mistake in raising these interest rates. And so Tesla closed last week at $223, or it is at $223.07. It was a bloody week last week. We're down 12.3%. I don't have the math for that, but we're basically overall we're expecting this important data, and it's the core inflation data coming up for next Thursday. Put it on your calendar. I would suggest 1-2, and that could be a significant market mover. Overall, the market's still getting pulled down. We had the unemployment report come out, and that was high, and so that was more push and pressure for the market to go down. And so basically what's coming up on Thursday and what just happened is gonna affect what might happen this week. And so and also November's break heights that will continue soon. So Tesla, where could we see Tesla right now for the time being? Between $115 and $150, we could see Tesla sitting for the next weeks to months. But there could be some massive surprise on the earnings day, and with inflation data, things could look a lot different than we expect. So always be on the lookout, right? You never know what the heck's gonna happen. Yeah, delivery numbers were down. They weren't to the numbers that they expected, and Europe has an energy crisis that's not good, and there's inflation skyrocketing in all different countries. So this is like the perfect storm. So at this point, I'm going to hand off this camera, my phone, to
See,
Queen.
well, let's just look at the numbers first. M2 growth peaked at 27% in 2020 and has been slowing ever since. It hit 4.1% in August. We believe it is closing in or might be below 3% on a year-over-year basis in September, which doesn't leave a lot of room for growth or inflation unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up. If anything, I think individuals and businesses are becoming more concerned and are spending less freely. So if you look at M2 also, you'll see that it actually peaked in March. Now, this is very unusual to see sequential declines in money. We have not gotten back above that March peak, and we may not get back above it the way that Fed policy is going. And I think I'd like to build the case a little more here that the Fed is probably making a mistake. I say probably because I have to from a compliance point of view, but I really do believe the Fed is making a mistake. And reflecting a little bit more on the Jackson Hole speech that Chairman Powell gave in late August, we've come to recognize that Chairman Powell really does think he is the reincarnation of Chairman Volcker, that we need him to take a sledgehammer to inflation, much like Volcker did. And history has treated Chairman Volcker very kindly. He did turn the tide on inflation. Now, what he did, though, was he turned a tide that had been building for 15 years. It started in 1964 with the Vietnam War and with the Great Society. So many social programs started at that time under President Johnson. And for 15 years, fiscal and monetary policy pretty much went rogue as we look at history. Even after shocks to the system, like the oil embargo, and the stimulus that came about because of it, both monetary and fiscal policy, we never saw the kind of slowdown in monetary and fiscal policy that we're seeing right now. Federal spending is still down 14% on a year-over-year basis. You never saw a decline in fiscal policy spending in the 70s. Monetary policy seemed to be on automatic pilot back then. The dollar was getting crushed toward the end of the 70s, adding to the inflationary fire. And so Chairman Volcker did choke off money supply and killed inflation. It took a long time for people to believe that inflation had peaked. In fact, I don't think many people believe it peaked as it did in 1981 until 1986 when oil prices crashed. So the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job. So that was over a 15-year period that inflation had built. By the time the Fed got around to tackling it this time, it was not a 15-year problem. It was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic. And we did not have the supply chain problems, 2 years worth of them, that we had because of the COVID panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations, and yet Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. It's at least 6 times bigger right now, and could be 8 to 10 times bigger if the Fed does raise the Fed funds rate another 75 basis points on November 2nd. And what do I mean by that? Well, Chairman Volcker was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. So while that sounds shocking, going from 10 to 20%, and it did have some shock value, it wasn't the same as what we're experiencing today with Chairman Powell and the Fed. Today, we've gone from 0.25% on the Fed funds rate to 3.25, which is a 13-fold increase, not a 2-fold increase. Now, many people, I was interviewed by someone the other day and said, oh yeah, but that was such a low base. There's no comparison. In fact, that makes this even more dramatic. That's what's so interesting. People dismiss this way of thinking about it, saying, oh yeah, but the base was so low. The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then, and it took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different. It's such a low base. That's the whole point.
That's it. And so I'll be having on my Instagram at Tuck Notes the link to this full video. I highly suggest you watch it. It's 43 minutes long. That's enough time for someone's attention span to get it. There's some more numbers and digits involved and some more history involved. Super great video. No one else is out there. Who else is out there telling you what's up and what's gonna happen or could happen? And so basically, Tesla's earnings week is next week. So we have updates about Elon and Twitter, and there's bad selling pressures for Tesla shareholders because of the Elon and Twitter deal. So key price area point that we're looking at, or key price support, is $215, and hopefully we get a bounce from that, and we look at something like maybe 223 or between 223 and 269. I do see a 269 before there could be a pullback, but hopefully, I don't know, we'll see what happens. I love you guys. If you like these videos, push the like button. If you want to subscribe and you like these videos, subscribe to the channel. It really helps out. If you got any questions or comments, talk to me. Shoot me a comment. I wish you the best of luck and stay safe. And I'll check you guys on the next day. Bye.